Hello, thank you for joining us and taking the time to view our video outlook for the second quarter. In taking some liberties with the old Wall Street axiom, don't fight the Fed, our thesis going into the second quarter is that when a major central bank is engaged in a very aggressive monetary stimulus, don't fight them, get on board, ride the wave, because in the short term, they're going to be successful in driving down interest rates and driving up asset prices. And with the major quantitative easing program that was announced last month by the European Central Bank, we believe they'll be successful in doing just that. With respect to the interest rates, 2015 picked up just where 2014 left off, namely with rates falling down across the spectrum, particularly in Europe. Here we see a couple of the major yields. First, the bonds, 10-year bonds yielding 18 basis points, and in fact, yields in Germany are negative out to about 7 years, a very unusual circumstance. We don't have time to go into it here, but we dedicated a couple of pages to some detail in that in our market letter this quarter. We suggest you take a look at that. Italy, former PIG, the yield on their 10-year debt is 124, and the U.S. 10-year yield is just under 2%. So U.S. has materially higher rates. This is keeping a lid. The low complex globally is keeping a lid on what rates will do here domestically. But unlike the last 2 years, we believe that this is the year that U.S. rates will actually rise. Now, they won't rise as much as they otherwise would with rates so low everywhere, but we believe that rates will gradually grind higher and the Fed will actually take some action. Now, higher rates in the U.S., higher growth has translated into a very strong dollar across all spectrums against all major developed currencies. In fact, against the euro, the dollar has appreciated over 20% in the last 9 months. And as this slide suggests, from a consumer standpoint, Europe's on sale. So's Japan, so's England. Here we're just looking at hotels in France. But the point is that if you are buying assets with dollars, things are cheap. And we're starting to see, in fact, American companies buy foreign companies with the appreciated currency. As far as client portfolios, this has implications with what sort of stocks we buy. We're very cognizant of the revenue mix of the companies that we purchase. Those that have a high component of revenues coming from exports, we're trying to shy away from, recognizing the headwinds they're facing from a high dollar. Not only that, but asset allocation also is impacted because small cap, we continue to be overweight because small cap companies tend to be on balance, more U.S.-centric in their customers and therefore a more pure play on the U.S. economy and less impacted adversely by a strong dollar. So implications for client portfolios of the strong dollar. The other thing we point out that's really important here as a subheading is the move has been very large in the dollar, but our belief is that the move has largely happened. Now, currency moves tend to last years, not months, but they don't move in a linear fashion. In other words, you can't get out your ruler and draw a straight line, is what's happened in the last 6 months, and think that's going to continue at the pace. The dollar, we think, will continue to be strong, but not move as materially as it has recently. So again, a large part of the move is over, in our opinion. Now, there's winners and losers with the strong dollar. As we mentioned on the previous slide, U.S. manufacturers are a loser. And here we're taking a look at the ISM, which is a measure of U.S. manufacturing. It's a reading that anytime it's above 50, manufacturing is expanding. Now you're seeing the line has been trending down, meaning that the manufacturing activity is increasing at a decreasing rate, going from the high 50s to the low 50s. So clearly a major headwind, again, has implications for the types of stocks we'll buy or avoid. On the other side of the coin, European manufacturers are benefiting. The weak currency is helping them. Those companies that export out of Europe are really starting to do well, and you're seeing this. It had been laying on the floor here, the European ISM, now starting to trend up. In fact, some indications in Europe suggest that quantitative easing is gaining traction faster there than it did in the U.S. Now, it's early. We'll see how that goes. But again, this is one of the reasons why we're overweight Europe in our international equity portfolio, because we believe there are signs, early indicators that things are working. The quantitative easing is starting to gain traction, and economic activity and asset prices are going to follow. With respect to the U.S. economy and when the Fed will raise rates, with inflation so low here in America, the Fed for the past couple of years has indicated one of their primary concerns is getting the unemployment rate down to what they term full unemployment or full employment. That had been deemed to be around 5.4, and as rates, unemployment rate that is, the U3, the headline rate that we see quoted in the press, approached that here last quarter. The Fed redefined what they term full employment to be closer to 5.1 and are still on hold, of course, and haven't raised rates like many have speculated they would. Now, we believe the Fed sensed what Main Street has been sensing for some time, and that is that the headline unemployment rate really understates how severe the unemployment picture really is, because there are many people that actually are unemployed that aren't captured in that number. And there's actually an economic number called the U6, which is a more robust measure of the unemployment picture here. You can see it has moved in tandem really with the U3, the one that you see in the media. But the U6 takes the U3, which is all the people that are unemployed and looking for work, and adds to that the people that are unemployed and have stopped looking for work or are working part-time and would like a full-time job. The point here is that the gap between the two is substantial. And if you look back historically, the spread has been much narrower. The point being, there are many more people, certainly in percentage terms, a higher percent, that are now sort of disenfranchised, that are out of the labor market, that would like to be engaged. And the Fed's aware of this. And the punchline is that we still have further improvement to go on the unemployment picture before the Fed will feel comfortable raising rates. We think that that will happen in the second half of the year, however, that the Fed will actually raise rates modestly, sort of have a change in the Fed cycle. But the unemployment picture has to continue to get better for them to feel comfortable doing that. With respect to stocks, there's substantial concern that this year earnings could actually drop here in the S&P 500, that because of the twin forces of low oil prices and a strong dollar, that presents substantial headwind. Now, last year, the S&P in aggregate earned $117. And a couple of months ago, the estimate for the S&P for 2015 was 129, which would be a great year, a 10% growth year. Now, if you move the calendar forward to where we stand today, consensus estimates for 2015 have fallen to $119. And they've fallen for the two reasons we mentioned before. One, strong dollar has presented a headwind for those companies that export, taking an estimated $4 out of earnings. Number two, low oil prices will really approximately halve the earnings of the S&P 500 energy companies, taking another $6 out of earnings. So a $10 haircut means that we'll get more like a 2% earnings growth if things play out as we think, rather than a 10%. The fact is, earnings, let's just say, are going to be essentially flat to growing modestly. If you couple that with a market that was trading at a fairly lofty 17 times earnings, you can see why, for the first time in over 5 years, in the last quarter, we reduced our allocation to large cap U.S. stocks. We went from overweight to neutral and redeployed those proceeds in international equities with an emphasis on developed markets, particularly Europe. Not because we're bearish on the U.S. market, but on a risk-reward basis, international equities were more attractive, and thus the move. The other major theme that we implemented here in the last month was an overweight to the energy sector. We believe that the fall off in energy prices, oil prices, was way overdone and presented a buying opportunity. There we added to a neutral weighting, took it to overweight in energy, because as the headline suggests on this page, the cure for low oil prices is low oil, meaning that when prices fall dramatically, it brings about a supply response, meaning less supply, and we've seen that in spades. Over the last 5 months, since October, the U.S. rig count has fallen from 1,600 to 800, and we've already seen that start to gain traction here in the price of WTI, where oil basically, we hope, hit a bottom in mid-March at about $42 WTI. It's now at $56. Now, it's not off to the races, but we believe oil prices will grind higher. So far, through the first quarter here and into April, the energy sector has been the best performing sector. This has been certainly a good trade, and one that we think will continue to be rewarding as the year progresses. To recap, the themes that we're implementing here as we enter the second quarter, we think that global forces will keep a lid on U.S. rates, but that they'll slowly trend higher. We think, though the dollar move has been very large, most of that move is over. It's not going to change course, but most of it's over. We think the Fed will ultimately hike rates sometime in the latter half of 2015, that the ECB's move, the major quantitative easing program, will gain traction in the Eurozone, and we're in fact starting to see that economy turn, and our allocation to Europe reflects our confidence in that. Oil prices, we think we've seen the bottom there as well, and that we think they're going to grind higher as the year progresses. And finally, currency aside, we think international equities will outperform domestic equities. Thank you so much for your time. We hope you have a great spring, and we look forward to catching up with you in early July.